Topic introduces derivatives markets and explains the role of derivative instruments in modern financial systems. Derivatives are financial contracts whose value depends on the performance of an underlying asset, index, interest rate, or other reference variable. Common underlying assets include equities, bonds, commodities, currencies, and market indexes. Derivatives are widely used for risk management, speculation, arbitrage, and portfolio enhancement. These markets have grown significantly because derivatives allow market participants to transfer risk efficiently and tailor exposures to specific financial objectives. Understanding derivatives markets is essential for evaluating investment strategies, managing financial risk, and analyzing the interconnectedness of global capital markets. The topic distinguishes between exchange-traded derivatives and over-the-counter, or OTC, derivatives. Exchange-traded derivatives are standardized contracts traded on organized exchanges such as futures and options exchanges. Standardization improves liquidity, transparency, and market efficiency because contract terms such as expiration dates, contract sizes, and settlement procedures are predetermined. OTC derivatives, by contrast, are privately negotiated agreements between counterparties and can be customized to meet specific financial needs. Common OTC derivatives include swaps and forward contracts. While OTC markets provide greater flexibility, they also involve higher counterparty risk because contracts are not guaranteed by centralized exchanges or clearing organizations. Central counterparties and clearinghouses play crucial roles in exchange-traded derivatives markets. Clearinghouses act as intermediaries between buyers and sellers, becoming the legal counterparty to both sides of each transaction. This structure reduces counterparty credit risk because market participants rely on the clearinghouse rather than individual traders to fulfill contractual obligations. To support this process, clearinghouses require margin deposits and conduct daily settlement through a mechanism known as marking to market. Gains and losses are calculated daily and added to or deducted from margin accounts. These risk management systems improve market stability and help ensure the integrity and reliability of derivatives trading activities. Forward contracts are among the simplest derivative instruments discussed in the topic. A forward contract is a customized OTC agreement in which one party agrees to buy and another agrees to sell an underlying asset at a specified future date and predetermined price. Because forwards are privately negotiated, contract terms can be tailored to specific requirements regarding quantity, quality, delivery location, and settlement timing. However, forward contracts expose participants to counterparty risk because there is no centralized clearinghouse guaranteeing performance. Forwards are commonly used to hedge foreign exchange risk, commodity price exposure, or future borrowing and lending rates in financial markets. Futures contracts are standardized derivatives traded on organized exchanges. Like forwards, futures obligate parties to buy or sell an underlying asset at a future date for a predetermined price. However, futures contracts differ because they are standardized and supported by clearinghouses that reduce counterparty risk through margin requirements and daily settlement. Futures markets are highly liquid and widely used by investors, corporations, and financial institutions for hedging and speculation. Common futures contracts include interest rate futures, stock index futures, currency futures, and commodity futures. Because of their liquidity and leverage characteristics, futures play a central role in global risk management and trading activities. Swap contracts are another important category of OTC derivatives. A swap is an agreement between two parties to exchange cash flows based on specified terms over a defined period. Interest rate swaps are among the most common types, allowing one party to exchange fixed interest payments for floating rate payments. Currency swaps involve exchanging cash flows denominated in different currencies. Swaps are widely used to manage financing costs, interest rate exposure, and foreign exchange risk. Because swaps are typically customized OTC contracts, they expose participants to counterparty credit risk and may involve less liquidity than exchange-traded derivatives. Nevertheless, swaps remain essential tools within institutional financial management. Derivatives markets provide several important economic benefits. Hedgers use derivatives to reduce exposure to unfavorable price movements, improving financial stability and planning certainty. Speculators assume risk in pursuit of profits based on expected market movements, thereby contributing liquidity to markets. Arbitrageurs exploit pricing inconsistencies across markets, helping align prices and improve market efficiency. Derivatives also support price discovery by incorporating market expectations regarding future interest rates, commodity prices, or exchange rates into observable market prices. Despite these benefits, derivatives can amplify financial risk if used excessively or without proper risk controls, particularly because leverage may magnify both gains and losses significantly. Topic ultimately demonstrates that derivatives markets are integral components of modern financial systems and investment management. Exchange-traded and OTC derivatives provide flexible mechanisms for transferring and managing financial risk across global markets. Instruments such as forwards, futures, and swaps enable participants to hedge exposures, speculate on price movements, and improve portfolio efficiency. Clearinghouses, margin systems, and standardized trading structures enhance market stability and reduce counterparty risk in organized markets. Understanding the structure, functions, and risks of derivatives markets is therefore essential for evaluating financial strategies, managing institutional risk exposures, and analyzing the broader operation of global capital markets.